All right, let's talk about a trading strategy that's so simple, it's based on just one single candle from the day before. Seriously, this is all about a mechanical approach that's designed to finally take all that emotion and, let's be honest, the guesswork out of your trading. Let's dive in.
And really, that's what it all comes down to, isn't it? This quote from J-Dub Trades just nails the biggest struggle for so many of us traders. That feeling that you're just guessing. Well, what we're going to talk about today is a clear, step-by-step process that's meant to replace that guesswork for good. Okay, so, Section 1. Escaping the guesswork. We're going to look at the power of the previous day's chart. So, how do we actually do it? How do we escape that constant guessing game? Well, believe it or not, it all comes down to one single candle. Yep, that's it. We're not talking about a bunch of complex indicators or mixed signals. We are focusing purely on the price action from yesterday.
Everything, and I mean everything, starts with the high and the low of the previous day's candle. And notice the key words here, on the daily chart. We're not down in the weeds on a 1-minute or 5-minute chart looking for levels. Nope. The whole foundation of this is the daily chart, because that one candle, well, that represents the entire battle between buyers and sellers from the day before. It makes its high and its low the most important spots on the map for today.
Okay, but why? Right? Why are these two little points on a chart so powerful? I get it, it sounds almost too simple. Just a high and a low? Come on. But there's a really powerful market dynamic happening here that makes these two spots incredibly important. Let's break down exactly what that is.
The magic word here is liquidity. You've probably heard it, but what does it mean in this context? Think of the previous day's high and low as giant magnets for price. Why? Because above that high, you have a whole bunch of buy stop orders sitting there. And below that low, a ton of sell stop orders. This huge concentration of orders creates what we call liquidity pools, and price just gets drawn to them, which is why we often see such big reactions right at those levels.
All right, next up, how to mark your levels. This is a simple 3-step setup. We get the why now, right? So let's get into the how. This is where we go from theory to an actual actionable plan you can use every single day. It's super straightforward.
Okay, 3 simple steps. First, you pull up the daily chart. That's our anchor, our source of truth. Second, you just mark the high and the low of yesterday's candle. Easy enough. But step 3 is where the real magic happens. You're going to drop down to a lower time frame, say the 15-minute chart, to turn those simple lines into actual trading zones.
And this brings us to a huge pro tip. Please do not use a single razor-thin line. The market is just not that precise, it's messy. So instead, you want to draw a zone, like a small box. Maybe you draw it from the top of the candle's wick down to the body. This gives the price what the source calls a little bit of wiggle room. It accounts for those little overshoots and makes your levels way more reliable.
Okay, Section 3, the 3 primary trade setups and how to read the market's reaction. So you've got your zones marked on the chart. Now what? Well, now comes the easy part and the hard part. You wait. Your job is not to predict what's going to happen, it's to simply react to what does happen. You just watch how the price behaves when it gets to your zones. This is where the beauty of a mechanical strategy really kicks in.
And I gotta tell you, this is so liberating. You don't have to wake up in the morning and try to figure out, am I bullish today? Am I bearish? That's just a recipe for disaster. It's a total guessing game. Instead, you let the market tell you what it wants to do when it hits your levels. You're just on the sidelines, waiting to spot one of 3 very specific scenarios. And these are the only 3 you need to know. That's it. Number 1 is the continuation. That's when price just blasts right through. Number 2 is the reversal, where it hits the level and bounces off hard. And number 3, my personal favorite, is the reclaim, which is basically a big fake out. Let's look at each one.
So let's compare the first two, continuation versus reversal, because they're the most common. A continuation is exactly what it sounds like. Price comes up to your zone, punches right through it, and just keeps on going. Super simple. A reversal is the complete opposite. Price hits the zone, slams on the brakes, and gets rejected hard, sending it flying back in the direction it came from.
Okay, now for the third setup, the reclaim. This one is such a powerful pattern because it's a fake out. It's designed to trap people. Here's what happens. Price breaks a level, and everyone thinks, oh, it's a continuation, and they jump in. But then, psych, it fails, reverses, and shoots back through the level. When price reclaims that zone, it can trigger some incredibly strong moves because all those trapped traders have to bail out.
All right, let's move on to a real-world trade example. We're going to look at a previous day low continuation on NVIDIA, or NVDA.
You know, theory is great, but seeing this stuff play out in real time is where it all clicks. So let's break down this short trade from the source material step by step.
So here's the setup for the short trade on NVIDIA. The key level we're watching is, you guessed it, the previous day's low. The context is that the stock is already trading below that level at the open. Then, the initial move is a push up to retest that level from below. So now, what was support is likely to become resistance.
So, what's the trigger to actually get in the trade? Well, first, price pushes up and touches our previous day's low zone. Then, and this is the most important part, a rejection candle forms. Look at that long wick sticking out the top. That's not just some random candle. That's the chart screaming at you that sellers just showed up and slammed the door right in the buyers' faces. That is your confirmation to go short.
And what happened next? The result was a beautiful, strong, clean push to the downside. It's a perfect, textbook example of a continuation setup. Price tested the level, we got our confirmation candle, and the trade followed through. This is what it looks like to react to the chart instead of trying to predict it.
So, let's wrap this up. Is this your key to consistency? We're going to talk about the core philosophy of this strategy. As we zoom out, it's really important to understand what makes this simple approach work so well. It's not about some magic formula, it's really about a shift in your mindset.
And if you take away only one thing from this, let it be this. The real power of this strategy is its objectivity. You are trading what the market is actually doing at levels you defined hours ago, not what you think or hope it will do. You do your homework before the bell rings, and then you just wait. This whole process takes your ego, your gut feelings, and all that bias right out of the equation. You're just reacting, not guessing.
So, I'll just leave you with this final thought to chew on. Could trading defined objective levels, instead of just going with your gut feelings, be your key to finding consistency? What if the goal isn't to get better at predicting the future, but just to get better at reacting to the present? Maybe it's time to trade the chart that's actually in front of you, not the one you've built up in your head. Just something to think about.